So, good morning, everybody. Today, we're going to continue on the discussion of the value of fundamental knowledge um, with trading the financial markets and how you are able to use this information to beat the market, right? So, today, we're going to discuss commodities in terms of how you were able to trade it, how you're able to mitigate the risk, how you were able to be impactful in terms of generating your potential profits, all right? So the things that you got to keep in mind is when it comes to trading commodities, all right? You got to ask, what are commodities? What determines the price action? Um, what are futures contracts? What are derivatives, all right? You cannot talk about trading futures contracts without mentioning derivatives, and we're going to touch on that. And I'm also going to just provide you with information about how you go about actually checking the data, the fundamental data on the economic calendar, so that you are able to be impactful when it comes to trading, because it's got to do with futures contracts, right? And we're going to touch on what is a futures contract, okay? So, what are commodities? Let's start there, right? So, commodities are tangible products, okay? Things that are either sourced from the earth or either grown, all right? So, for example, it could be soybeans, it's corn, it's cattle, it's oil, it's gold, it's copper, silver, and cocoa, for example, is my favorite, right? Now, trading cocoa, because cocoa is very useful, right? Because what do you need cocoa for? You use it for hot chocolate, you use it for chocolate, it's used for baking as well, right? So, to understand how to trade commodities, one has to understand futures contracts and derivatives, okay? So, according to Investopedia, let's look at the explanation of a futures contract. So, a futures contract is a legal agreement to buy or sell a particular commodity, asset, or security at a predetermined price at a specified time in the future. So that is why it is called futures contracts, because you're never going to trade a futures contract for the particular month that you are in. It's always going to be in the future, either a month, 2 months ahead, right? So futures contracts serve two main purposes, right? That could be for hedging, where participants secure prices against market fluctuations, right? So futures requires a margin account and usually involves complex risk management strategies appealing to both retail and institutional investors, right? Now, futures are financial contracts whereby the buyer sets a price and the seller sets a price. So you get a buyer and then you get a seller, okay? They come together and the buyer sets their price and the seller sets their price, all right? And between the difference of the buy and the sell, that is, and it's also got to do with supply and demand, because it plays a major role in terms of futures contracts, all right? Because commodities are, like I said, they're sourced from the earth or they're from the ground. So there are lots of circumstances that could actually affect trading futures contracts, and we're going to go over that now as well, okay? So the seller will set their price, and then the buyer sets the price, and then the price is based off the supply and demand. So you derive your potential profit or loss of the underlying asset due to the price action, the difference of the price action, right? So futures contracts are just exactly what it states. It's a futures contract, okay? You're not going to trade a contract based off the present data or the present date that you are in, right? It's based off commodities supply and demand, okay? So there could be risk factors at play, all right? So what happens is there's geopolitical unrest, environmental factors, inflation risk, which could affect imports and exports, as commodities are grown or sourced from the earth, okay? So it's got to be extracted from the earth. It's got to be sometimes refined, or it's got to be exported, it's got to be imported, and there are a number of factors as well that that actually affect the supply and demand or the price action as well in terms of the futures contracts, all right? So one can speculate or futures contract determining the movement for that particular month based off the contract data, all right? So that will be using your fundamental and technical data to determine which way in order for you to place your positions, all right? Now, we cannot talk about futures contracts without talking about risk as well, okay? Because there are different types of risk in terms of the market that you got to watch, and you got to make sure that you are in line with what is actually transpiring, and you got to keep abreast of the market in terms of the interest rates and things like that. So we're just going to discuss um, what those particular risks actually are, okay? So you get a market risk, right? Then we get liquidity risk, we get interest rate risk, currency risk, inflation risk. We also have psychology risk and regulatory risk, right? In terms of the financial markets, in terms of trading futures contracts, okay? Because futures contracts, there are a number of financial instruments that comprise of futures contracts. We're going to go over that as well, okay? So let's break down the different types of risks and how it can actually affect you in terms of trading and what you got to watch out for, right? So we get a market risk, which can be uncertainty regarding the markets, okay? And then we have a liquidity risk, which could be your overexposure, interest rate risk, a higher interest rate, more options for saving with the banking sector, potentially higher returns on savings, all right? However, it can affect different aspects in terms of the financial markets. That is why it is very good to watch the interest rate, because it does have a direct impact on the general consumer, okay? Then we have inflation risk as well. Credits could be higher, all right? So less buying by consumers and funding by clients, okay? Because why? There's less money to spend and you're more inclined to hold on to your money, because why? The price of goods and services now have become quite costly, okay? So no one wants to pay, especially for us ladies, we know exactly how much things cost, all right? So we know that when the price escalates, this is not the price that we used to pay a couple of months or so. You'll find that your groceries or your toiletries or your insurance or your bond or your petrol is gone up by 300-400 rand, and it makes a difference, because you'll find that there's an extra five rand. If you're in South Africa, I'm gonna talk about rand. So you'll find that there's an extra 5 rand that is added onto the price, an extra 10 rand there, and it all makes a difference, because when you are um, shopping, you'll find, oh, but this used to cost me so much a couple of months ago, but now the price has increased substantially, okay? And then we also have psychology risk. So the psychology risk also plays a factor, because the client can also blow their account, right? If they don't have the correct fundamental data or the correct fundamental information. The reason why I'm saying that is because, let's say, for example, we're going to use the futures contract. So the futures contract, maybe it is that you didn't do your due diligence, you didn't go and see which way the market is trading for that particular month, right? So let's say, for example, all the months you were trading, let's say, hypothetically speaking, we're going to talk about cocoa. You were trading cocoa, right? And all the time it was in a buy position for the past couple of months. So now the contract has been released, and the contract now moves in a different direction. Now it's in the opposite direction. So now you have opened a position on buy without viewing the fundamental data, without checking the contract information, and now it's in the opposite direction, which is going to a sell. So now the psychology risk is going to play on your mind, because now you're going to be thinking, oh my gosh, I'm losing money, I'm losing money, I'm losing money. But if you had done the fundamental if you went to do your due diligence and you checked the fundamental data, you would have checked, okay, the price has moved, let's say, for example, from 6,000, now the contract maybe 6,250, and now it has moved to maybe 5,000, let's say 5905, for example, all right? That also plays a major risk because you've got to take into consideration when you have your margin in your account, which is your balance, and then you're going to open your volume of lots, right? Let's say, for example, you open 0.30, and let's say for one volume of lots, it was $6,000, all right? So you've got to calculate in half a lot, it's going to be maybe about, let's say, give or take, plus minus. I don't want to speculate because it's got to do with leverage as well. Because if you have a higher leverage and all those type of things, it's going to affect the potential returns on your account. So let's just say, hypothetically speaking, it was maybe about $3,000 or maybe $2,950, all right? And it's going to play a major factor because that difference maybe is going to be it could be maybe a $250 difference or $300 difference. It can play a major factor depending on now the volume of lot that you have opened and the leverage that you have, because leverage is going to be also got to do with overexposure. Okay, so when you are trading as well, you've also got to view and keep in mind your leverage as well, right? Because leverage plays a major role in terms of your returns, in terms of how you are going to manage your account, all right? And then also we have the regulatory risk, selling within the guidelines from a regulatory perspective, all right? So based off a client's social adaptive style, okay? One will be able to sell and categorize the investor. So there are four types of social adaptive um, behaviors, right? In terms of clients, in terms of the style, and how you're going to go ahead and categorize an investor. Okay, so you have a driver, right? A driver is a more, motivated, driven person, and they could fall into the category of a moderate to aggressive investor. So remember, I told you there is three types of investors. There are moderate investors, there are conservative investors, and they're also aggressive investors. So you also got to bear in mind as well in terms of when you are trading, and also, if you're trading from your own perspective, you also got to bear in mind the psychology of the trading as well. If you're feeling frustrated and there are many things that you need to do in your home, let's say, for example, you want to trade the NASDAQ, and it could be maybe the NASDAQ was a little bit more volatile in terms of that. You also got to do your fundamental data. You got to go ahead and check as well what is being listed, all right, even on IPOs. That is also going to affect the movement of the indexes as well, not only the stocks, not only the earnings report. So it's good to do comparison as well. So check IPO calendar, which is also on investing.com. I'm not getting paid from investing.com. It's just something that I like to use, and I find that it's user friendly, right? You are able to get everything there. There's dividends calendars, there's futures contracts updates, there are earnings calendar. There's everything that you need to know pertaining to the market. There's news. There's a whole lot of information that you're able to see. You're able to actually see the movement of the market as well. There's signals. There's everything there. Okay. So we also have an analytical person, all right? Someone who is very data orientated. They want to know facts, okay? So these fall under maybe a conservative to a moderate investor. And then we have an expressive person who could be a moderate to aggressive investor. And then we have an amiable person, which is a moderate, aggressive, or conservative investor, because these tend to be a little bit more friendly in terms of how they work, in terms of how they adapt to social, like they're very socially adaptive people, all right? Very friendly. They're more inclined to say yes, 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 um, because they don't want to become, maybe they don't want to be a little bit difficult, right? So you'll find that these amiable persons who are a bit more, a little bit undecisive. So they can say yes, and then maybe they have buyer's remorse at a later stage, and they tend to change their mind, all right? And the things that comprise of the financial market. So you're going to get the market, the money market, you're going to get the capital market, the property market, the equity market. Now, I'm going off based off South African, South African wealth management, the way we were taught, right? And the way things are done in South Africa. Okay. And then also, conducting your due diligence is very important, as you may be at risk of liquidating your trade account, right? So if you open a position in the wrong direction, you could either need to take the L, which is the loss, or you could top up your account to sustain the position in the event of the market retracement. So I'll give you an example of the futures contract. So let's say, for example, now you it was in the buy position for the past couple of months, and the direction changed because of supply and demand. Okay, and now it was in favor of it was in favor maybe of the 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 seller, so it went in a different direction, all right? Or it was in favor of the buyer, whichever way we're going to talk, because it is a bit difficult to speak about it like this and then not to show you on the actual the the trade account, okay? But I believe that fundamental data is more important before you even touch your trade account, because what's going to happen is that you're going to get frustrated, you're going to get angry, you're going to want to withdraw your money. You're not going to be able to understand which way the market is moving. You're not going to be able to understand how to read the news, how to check the fundamental data. All those are major factors in terms of trading your account, okay? I mean, of a trade account. And then also, yes, as I was mentioning, now maybe let's say, for example, it goes now in the opposite direction. So what's going to happen is you're going to find that now the market has moved against you. But the market has not moved against you. It's because you didn't do your due diligence, because all the information is there. The contract information is there. When you look at the contract information, they give you contract information from 2025 right up until 2027. So it's not carved in stone. Sometimes it is speculative, because remember, it is based on political events. It's based on imports and exports. It's based on inflation risk. So that is why you cannot talk about all commodities. You cannot talk about all these other things without talking about risk in terms of the types of risk that affect the market. And also, you cannot talk about commodities without discussing derivatives, okay? Because we're going to discuss it a little bit more, all right? So what are derivatives, okay? Derivatives are forwards, options, swaps. That is what the dictionary defines it as, okay? It's an arrangement or product such as a future option swap whose value derives from and is dependent on the value of the underlying asset, such as a commodity, currency, or security, okay? So in other words, derivatives basically are the difference between the buy and the sell of the underlying asset, and then you derive your profit or loss based off based off the direction of which you have taken that particular trade, okay? And then you are going to get that derivative, right? So you get agricultural futures, okay? So for example of agricultural futures, we're just going to discuss the different types of futures, because there's 4 categories. You get agricultural futures, which is cocoa, soybean, it can be cattle, it can be corn, it's basically agricultural things, all right? Then we have metal futures like silver, gold, then we have currency futures, and then we have financial futures, okay? But we are going to touch on the commodities, all right? Because the commodities is what I wanted to actually discuss, and what it is that I wanted to chat on, all right? So to establish whether it's a buy or sell or even a hold, right? Going to the instrument, for example, let's say we go to crude oil WTI, all right, on investing.com. As I've mentioned in my previous upload, that every Wednesday the report is released on investing.com. You will find it there. It's going to tell you crude oil inventories. The information is normally released about 3:30 South African time. It could be a little bit early American time, all right? So you click on or touch on the crude oil. So what you're going to do is you're going to type on crude, you're going to type in the search bar on investing.com. You're going to type in crude oil WTI, okay? Then when you type in the crude oil WTI, it's going to bring you the price, all right? So on the price, there is, either if you touch on that price, you're going to see the data of contracts, or if you scroll to the right, you're going to see contracts, all right? So the contracts are going to bring up, it's going to tell you $60.05 or $62.50, for example. Then it's going to tell you maybe 62.57, but these are giving you the speculative prices for the next couple of months, right? So that you are able to plan, okay, in terms of how you want to execute your trades. Because if you are uninformed in terms of how to trade, you are going to liquidate your account. That is what is going to happen, right? So what you got to do is you got to bear in mind, you've got to take into consideration that contract information, because all the contract information is going to be there. And the price of crude oil tends to actually change the direction. And I've noticed this. So it's not carved in stone, but it's something that I have noticed in terms of trading, especially when I speak to my clients as well when they're trading crude oil. Okay, I will see that direction is going to change in 4 to 6 weeks. And if I'm not sure of which way the market is going to trade, because crude oil is one of those things, it's going to either go up with $1.30, or it's going to go down maybe with $1.30 or $2. But basically, it plays between the amount of maybe $2, right? Where it's going to go up or down. So which means that as a trader, if you are opening your position, you are able to plan, okay? But you need to go into your technical indicators and go to the candlesticks and go and see the price action, and also got to see the contracts, all right? And go ahead and look at the crude oil inventories, okay? So when you go and scroll, you will see basically the historical data of how it was actually trading, all right? Maybe 4 to 6 weeks later, then you can more or less draft your price points that you want to enter and exit the market, okay? So like I said, when it comes to trading, you are in this trading CFDs, you are in control of how you're going to execute the trade, because you are able to look at the historical data and actually have a look and see how you want to execute that trade. So you can open on a, let's say for example, because there is a take profit and a stop loss, all right? So what that means is that you are able to see how much that you want to potentially make, and it's going to tell you, all right, according to this volume of lot, this is how much. If you open at this particular price and if you drag it up, okay, let's say maybe you set the price for, maybe it was trading at $60.40, hypothetically speaking. So now you're putting your take profit at 64.40, okay? And depending on the volume of lot that you have chosen, that is going to determine your potential profit or loss, okay? So you can determine how much money that you want to make for that particular day, or you can determine how much you're not willing to lose for that particular day. And whether you're online, whether you're not online, your position will automatically close if you put in those if you put in your take profits or your stop loss, all right? So let's go back now. So you're going to click on the crude oil, okay, and then you search for contracts, all right? So under the contracts, you will see the speculative price, okay? You will receive an update even up until 2027 of the speculative price that it is going to be, because bearing in mind, as I've touched on, it moves with supply and demand, okay? So the prices are subject to change. So every Wednesday, the report is released on investing.com, the crude oil inventories, okay? Once that report is released, it starts to send the market moving in a certain direction. So it's either going to go in the buy or sell. Then you will see the market moving, like really moving, okay? So if you're someone who likes an adrenaline rush, crude oil is nice to trade. That is up to you, okay? Now, using fundamental data and the technical data is very imperative, okay? To receive optimum results and to also mitigate risk, okay? So as I've mentioned, bearing in mind that oil seems to change the direction every 4 to 6 weeks, okay? So even if you maybe opened in the wrong direction, and you have the funds available in your account, now your account maybe is in a minus $2,000, for example, okay? Depending on the volume of lot that you have opened and the leverage that you have in your account and the price action as well, because that plays a factor. So now maybe you losing about $2,000, okay? And now you've done your due diligence and you know that, okay, the market is going to retrace, right? Because there's also historical data on the charts as well. You are able to see the historical data, so it's going to give you an overview, an outline of how the price action was moving, right? So you could either top up your account, okay, to hold on to that position, to wait until that 4 to 6 weeks is over. And this has happened a number of times, especially with my clients as well. They were in a minus maybe $2,500 or minus $4,000, and told them, no, what you need to do is just hold the position, just hold it, because what is going to happen is it's it could potentially change, right? So you gotta wait it out because don't let the psychology of trading get to you. So I would listen to some of the clients and say, okay, this client frustrates. I say, what you need to do is you need to log off and go and take a walk or do something, because the psychology of trading is going to get you. And what you're going to do is you're going to close your position prematurely, and then the next week the direction of the price of the oil could change, and now you, instead of being in a minus $4,000, now you're in a plus maybe $5,000. So your potential profit, instead of you losing your $4,000, now it has changed the direction, and the market now has moved in favor of you, and now you're in a plus $5,000, right? Now, if you had closed your position, you would have been minus 4,000, minus that money off your margin, off your trade balance, off your trade account. And now, because you waited it out, you have potentially your $6,000 profit together with your initial investment, which is about maybe $8,000, give or take. So I'm speaking from a hypothetical perspective, right? Everybody's trade account is different. Everybody's margin is different. Some people like to open a leverage of 1 is to 500. Those guys are, they will blow their account in less than 30 minutes. So you will not trade, and this is very rarely based off current data. It is always at a predetermined price in the future, especially when you are trading futures contracts, right? You are not going to trade a futures contract this month for this month, if you know what I mean. You are going to trade it in the future. So it's going to be, let's say, because we are in November, right? So you're either going to trade it, the futures contract, for December, or it will be in January, okay? Because um, these are already based off supply and demand, okay? So that is why it is very important in terms of the imports and exports, all right? Because these play major factors, all right? In terms of how you're going to be able to generate your potential profits, okay? Commodities, are commodities a little bit more volatile? Yes, they are. The margin required to trade a commodity as opposed to trading a forex pair is different, right? So as I've mentioned in my previous video, maybe you would open a volume of lots of 0.45 on a currency pair, and now you want to trade a oil, for example. The margin is going to be different. So you want to trade cocoa, instead of you opening 0.45 volume of lot, you'll open 0.10 because it's different. All right. Now, I forgot to mention as well the factors that are going to affect commodity prices and how you trade commodities, how you trade futures contracts. It's geopolitical unrest, right? Because if there are unrest in the government, if there are unrest with particular countries that are fighting as well, what is going to happen is it's going to affect the imports and exports, right? And environmental factors, where because now these are commodities, um, they are based off supply and demand, right? And let's say, for example, corn or potatoes. If the potatoes is not there, so let's say cocoa, for example, because I like to trade cocoa. Um, Cocoa, and maybe there's political unrest in that particular government or in that particular country. There's war or they had a drought, right? That is going to affect the price as well of commodities, right? Then we have inflation risk, which is going to affect the price as well, and it's also going to play a part in terms of the trade balances with those particular countries. Okay, because inflation risk is going to affect now the imports and the exports, right? Because why the supply and demand will be a little bit maybe less, because why it's going to be higher. So the trade balance would get as a deficit depending on supply and demand. So all these things, they all go together. They all go together, and it's one let's say, conundrum of many factors, right? That in order for you to mitigate your risk, in order for you to trade and be intentional in terms of opening positions so that you're able to beat the market and capitalize of how you want to um, base your trade account on. So I am speaking, as I've mentioned, from a CFD, contract for difference perspective, okay? Meaning that you are the one who assumes all the risk and you trade for yourself. So these tips and tricks are to assist you in terms of maybe you are considering that you want to open your own trade account and trade for yourself. This is basic information in order for you to know how to move your account, how to handle your account in terms of which way that you want to trade. And these strategies of mine have actually proven to be very effective in terms of how clients generate their potential profits. Okay. So guys, thank you for your time. I would appreciate it if you would like, subscribe, even donate to this, so that we can keep this channel going and for me to provide you with this knowledge. Okay. So this is just fundamental data. This is what I've gathered over speaking to hundreds of clients. And I've also come to understand that many clients don't understand how the market works and how these factors play a major role also in your day-to-day life as well. So I hope you find this video informative. I have linked my information down if you want to donate to my so that I can continue to provide these teachings. And thanks in advance, everybody. I appreciate it. If you want me to touch on things and go in a little bit further to explain, I'll be more than happy to do so. So thank you for your time and enjoy the rest of your day. Take care. Bye.